Have you calculated what you need to get to financial independence so you have complete freedom and control of your life to do what you want when you want? And then you realize that that number you need is so far away that it feels like a fantasy. A few years ago, I felt the same way. So maybe I can share some of the things I did and learned along the way and hope it can inspire and educate some of you in your journey. I'm Vinny, and I reached financial independence at 45 and retired from my career in technology so I could play competitive sports, travel the world, spend more time with the family, and gain new experiences. And today, I'd like to share some steps that you could take towards getting to FI down the road. And if you're unsure about what number you need to get to financial independence, please watch the video on calculating your number linked in the description below. Now, if I go back about 12 years before I reached financial independence, early retirement seemed like a pipe dream. My family's combined income was not even six figures annually. My investable assets were less than $100,000, with more than 50% of that being in my 401k and the rest in a brokerage account. My career wasn't going anywhere. I was working 9 to 5 at a pretty much dead end job as a programmer. Uh, but end of the day, I was happy and content. The job felt secure. I had a lot of time to play sports. I played cricket like 4 times a week. We took a lot of short vacations within the country. Life was good. But the thought of retirement scared me. And it was easier to not even think about it until I found out we were pregnant and expecting a child. Sometimes you need a jolt to get over that inertia. And this was my jolt. As a parent, your natural instinct is to want to provide everything that your child needs. And I felt that just budgeting, saving, and investing was probably not going to get me in a comfortable position to even pay for college in 18 years. It was clear to me that I needed to make considerably more money, and so I decided to invest in myself and go to grad school. I got an MBA. It was a weekend program, so it allowed me to continue working, but it did require me to pretty much deplete my savings. MBAs are not cheap. So if it didn't pan out, this would have set me back even further. However, it did. And within 4 years, I was making about 5x of what I was making before. And it also allowed my wife to retire when my daughter was 4 years old. And this by itself was a game changer for our family. Now, where I'm going with this, if you look at the numbers today and you feel that you are on track with your savings, then ignore this part. But if you look at the numbers and it feels so far out of reach, then the first thing you may want to do is invest in yourself so you can make significantly more money in a way that scales. In my case, it was the MBA. And I'm not going to get into how the MBA helped me and how I grew my career. That's a whole other journey by itself. But the point is, you have to take a risk and invest in yourself. Whether it is getting educated, gaining new skills, or even starting a business that can potentially scale. Now, scaling is important. So I wouldn't go about and do some gig economy job like to make a few extra bucks, like driving an Uber or being a part time referee in some league, because those things won't scale. In my opinion, at that stage in my life, the biggest risk would have been not taking one. Now, if you are already on the journey and making significant income, then you want to start focusing on the expense side. And the biggest thing that helped me here is not inflating my lifestyle at the same rate as my income was growing. I saw people around me at my position buying $1 million houses, fancy $100,000 cars, etc. I didn't. Keeping up with the Joneses is the fastest way to derail your FI timelines. Your friends and colleagues most likely are not on the same journey you are. Then why follow them? Why follow the crowd? Do what's right for you. Don't care what other people think. We did move to a bigger house in an older neighborhood, but mainly for better schools. But the older house was nearly half the price of the newer, fancier communities where my friends were buying. So I bought a house in 2014 that was about the price of my 1 year annual income, and it allowed me to pay it off within a year and a half. Now, considering I had a 3.25% mortgage rate at the time, it was probably not the best financial move. And I knew that. But being debt free and the peace of mind associated with that was far more important to me. And I don't regret that decision. I regret many other decisions, but not that one. The other expense I often see is cars. I look at cars as a means of transportation to get me from point A to point B comfortably and safely. I always bought low mileage, pre owned certified cars, even if they were luxury cars, and typically drove them for years after they had been paid off. Now, I don't want you to think that we were living frugally by any means. There were things that we would not compromise on, like food. Like we only bought organic groceries, even if it was 4x the price of regular groceries. We went on several international vacations. My daughter at 14 has traveled to nearly 40 countries. Travel and hiking is something we really love as a family, so we would spend on that. But we didn't fly business class, even if we could afford it. In fact, we used miles and points and several travel hacks to minimize our expenses even on our vacations. We preferred to stay in Airbnb apartments instead of luxury resorts. Because when we travel, we spend most of our time outside, seeing places. And the only time we needed the accommodation was for bed, for showers, and having breakfast. We do a lot of grocery shopping at local stores, get that local flavor. The point I'm trying to make here is identify the things that really matter to you and give you happiness and spend on those. But avoid the expenses that you do just because everybody else is doing it. And then beware of those impulse buying. You know, things that you will buy, use a couple times, and then eventually it's just rotting away in years of storage before you finally discard it as junk. Understanding what truly gives you happiness and doubling down on those few things will help you getting to retirement and also after. Now, there's this podcaster, Paula Pant, I like listening to, and she says, you can afford anything, just not everything. So now that you are growing your income and keeping expenses in check, you will have savings. Invest, invest, invest. Like buy assets that will grow over time. Early on in the journey, you can be aggressive. And it doesn't matter what asset class you invest in as long as you invest. Money sitting in the bank is actually losing value due to inflation, as I'm sure you all know. So, apart from what you need to live and some emergency funds, invest everything else. Please don't keep more money in your checking account than you need for expenses. Now, invest in what, you may ask. What are investable assets? In my mind, anything that grows in value over time, or even if it doesn't grow in value but provides you some cash flow returns, is an asset. Now, although a lot of people consider a primary home as an asset, for the purpose of calculating investment assets, I have never included that, the equity in my primary home. Yes, eventually later in life, I could sell the house or do a reverse mortgage, and maybe I could pay for assisted living in old age. But I'm really not factoring that into my calculations for simplicity. Let's just say that's for the heirs. So for me, investable assets are stocks, real estate, bonds, CDs, loans, private businesses you invest in, VC funds, crypto, gold, etc. For the first few years in the journey, my investments were primarily in the stock market and real estate. My focus would be on growth and not cash flow, at least early on. Now, as you get closer to retirement, then obviously you may want to change your asset allocation and maybe have some more fixed income type assets. Now, it is very tempting early on in the journey when you have so little to invest to think like, hey, I have only $10,000 to invest, and a 10 to 12% return will only get me from 10,000 to 12,000 next year. What if I take it all and put it in Bitcoin, or worse, some altcoin that can go 5x in a year? What if I buy call options on, say, Nvidia, and it goes to $800 a share before the calls expire? I would have 10x in a year. Yes, these are very tempting because we feel like this is going to take forever, the standard traditional path, and we want instant gratification. I made all those mistakes. I had my brokerage account go to nearly zero in 2008 when I bought a ton of call options. So, what had happened was I had just got into options trading and I had made 14x on a call where I bought some LinkedIn call options. And before the option expiry, Microsoft announced that they were purchasing LinkedIn. So I had only invested $500 and that had become $7,000 within like 2 or 3 weeks. And I thought I had discovered the formula for success in the stock market. And I gambled everything I had. And you all know what happened in 2008. And I lost everything. Please don't make those mistakes. Invest, don't gamble. Now, one thing that helps immensely is setting up automatic and recurring payments for your investments. Now, if you don't have it sitting in your bank account, then you're less likely to spend it. So remember what I said about not inflating your lifestyle as you generate more income? I kept the same amount of money in the bank account, maybe a little more, for expenses as before I was making even six figures. Um, the rest was all invested automatically in either a 401k, HSA, 529 plan, brokerage accounts. Like most of the accounts were invested in S&P 500 or some sector ETFs or total market funds. I did buy a few individual stocks, and looking back, um, that was a mistake because the total market over time has returned much more than my individual stock picking. Maybe I'll make a video about what not to do when investing because I've made a ton of mistakes in my journey. So, a big chunk of my salary was being invested directly into the stock market. And then, whenever I would get the annual bonus, I would take all of it and invest in areas that required like a sizable chunk as a minimum investment, like buying maybe a rental property or buying a share of a real estate syndication deal or buying a stake in a restaurant, which I did once, or some other business. Um, I didn't view the bonus as an opportunity to reward myself, but instead as an opportunity to bring in my retirement timeline. So just invest as much as you can into boring stuff like ETFs and maybe real estate, but please don't gamble. Losses hurt a lot more than when you make similar gains. And gambling losses can really affect mental health and send you in a downward spiral. Now, is there some order of priority about where I invest? I think there is. Um, this is where tax considerations come into play. Like, my first priority would be to maximize investments in tax free accounts. When I say tax free, I mean that once you put your money there, it compounds over time and you don't pay a dime in tax when you take the money out, irrespective of how much it has gained, right? The three accounts like these that I'm aware of would be the Roth 401ks or Roth IRAs, the HSA, and 529 plans if you have kids and you're planning to pay for their education. Now, the money you put into these are after tax dollars, but all the gain is tax free. After that, the next I would max out is the 401k, which is tax deferred. I believe the max you can put in there is around 23,000 a year. But then most companies match a certain amount, so that's free additional money that I would not pass upon. So you invest pre-tax dollars, but it's a tax deferred account. So eventually you will be paying taxes on all of it when you take it out. And there are some things called required minimum distributions or RMDs after you hit, I think, 73 years old. But I believe, you know, those can be mitigated. Let's not worry about that right now because there are ways like Roth conversions where you can mitigate those RMDs. And then finally, the rest of the investments in taxable brokerage accounts or alternate investments like real estate. Now, tax efficient investing can reduce your retirement horizon by years. So, do take advantage of all those programs. Now, finally, after you've done all of this, trust the power of compounding and stay the course. You will have bad years. You may have a significantly bad month and your portfolio can drop down 20%. But as long as you've invested in broad market funds, it always bounces back. Like imagine if you got scared and sold when COVID hit and the market went down like I think 30% in a few days. But then we had a V-shaped recovery and in a couple months the market was already higher than what it was before. So if you had stayed the course, you would have been fine. But fear is normal. This is a big part of your savings, so it's natural to be scared. So this is what I do when we hit downtimes in the market. I don't even log into my brokerage account. I don't want to know. If I know, I might be tempted to sell. So I just don't think about it. But you do you. You use whatever strategy will work for you to stay the course and be patient. And just trust the power of compounding. It has always worked. Now I believe with real estate and stocks, you average out somewhere around like 11% returns annually. And when you compound that, the results are simply magical. Like if you started from scratch today and you invested $100,000 each year for the next 14 years, you will not have $1.4 million. Dollars. I know you know that. But you will have $3.5 million. Dollars. Is that close to your FI number? And that's being conservative. So today I spoke about 5 generic steps to getting to FI. None of them are rocket science. Very simple concepts that you probably already knew. So what's getting in the way? It's taking action. These steps do not have to happen sequentially. So go ahead and start with any. For instance, if you don't have a brokerage account, just go online and open one. Go to fidelity.com, just open one. It takes few minutes. And then set up a recurring investment into maybe an ETF like VTI, which is a total stock market fund, and it's very low cost. Or go to your company benefits page and maximize your 401k if you're not doing it already. Or go to like Vanguard and set up a 529 plan with recurring investments. Don't just watch these videos, take action. I know the step one about scaling your income is the hardest, and it will take a lot of time to think, process, and figure out what you want to do and get started. But don't let that be an excuse to procrastinate on the others. Time is money, and more time in the market is more money. So grow your assets, take your first step or your next step towards getting to FI, and savor the journey.